Hello and welcome back. Attorney Andrew Bethel, and today we're diving into a crucial topic for those of you looking to protect your wealth and ensure a smooth transitions for your loved ones. In a previous video, we discussed crummy trusts, a fantastic tool for sheltering your money from certain taxes and creditors. But today we're going to take a step further and focus on a specific type of crummy trust, the Irrevocable Life Insurance Trust, or ILIT. This is an incredibly powerful tool for estate planning, so let's dive right in. Before we get started, don't forget to hit the like button, subscribe, and share the video with someone in your family who's interested in building generational wealth. And as always, thank you very much for watching. First, let's quickly recap what an irrevocable crummy trust is so we're all on the same page. An irrevocable crummy trust is one that, once set up, it cannot be changed or revoked. It's essentially set in stone. This separation offers several significant benefits. The assets in the trust are protected from creditors, both yours and those of your beneficiaries. Additionally, if the funding is done correctly, you won't owe any gift or estate taxes on those assets because they're no longer considered part of your estate. Now let's talk about funding the ILIT, because this is where things can get a bit tricky. Since the trust is a separate entity from you, any money or assets you transfer into it are considered gifts for tax purposes. And as we all know, gifts can trigger gift taxes. To avoid this, we have to follow a specific procedure. After funding the trust, you must send a notice to all the beneficiaries of the trust, informing them that money has been put into the trust and they have a short period of time to withdraw their share. Now, I know this might sound strange. Why would you tell them that they can take the money out when we don't actually want them to? But this step is crucial. It's what allows that transfer to be considered a gift for tax purposes, thereby avoiding a potential 40% gift tax. The understanding here is that the beneficiaries won't actually withdraw the money, which is the whole point. Everyone needs to be on the same page. If a beneficiary were to exercise their option to withdraw their share, then it would undermine the entire point of the trust. So what distinguishes an ILIT from a regular irrevocable crummy trust? Well, an ILIT is specifically designed to hold a life insurance policy. Here's how it works. You typically fund the ILIT with cash, usually on an annual basis. The trust then uses that money and pays the premiums on a life insurance policy. When you pass away, the life insurance policy pays out to the trust, not directly to your estate. Because the trust is separate from your estate, this payout is not subject to estate taxes or creditors. The ILIT is essentially a vehicle to pass on a significant amount of wealth to your beneficiaries without it being reduced by estate taxes or from any creditor claims. Let's talk about why you would want to set up an ILIT in the first place. And there are two main reasons. First is to reduce your taxable estate. By moving money into the ILIT, you reduce the value of your estate. This is important because it helps minimize potential estate taxes. For example, in 2024, you can gift up to $18,000 per beneficiary into the ILIT without triggering a gift tax. This money then grows within the trust, and the life insurance payout becomes a significant asset that doesn't count towards your estate. And number two, avoid estate taxes on life insurance proceeds. The second purpose is to pass on a large chunk of money through the life insurance payout without it counting towards your estate tax exemption. Remember, if the life insurance policy is part of your estate, it would be subject to estate taxes, which we want to avoid. Now let's quickly cover estate tax exemptions because they're a critical part of this discussion. The federal estate tax only kicks in if your estate exceeds a certain threshold, which for 2024 is $13.6 million. That's a high number, but it's tied to inflation and politics, so it could change. In fact, as of now, if Congress doesn't act by the end of 2025, then the exemption is set to be cut in half, potentially dropping to around $7 million in 2026. Additionally, some states have their own estate taxes with much lower thresholds. For example, Oregon and Massachusetts have a threshold as low as $1 million. So depending on where you live, your estate could trigger estate taxes even if it doesn't reach the federal level. Because again, what's included in the estate tax calculation, it can be real estate and it can be retirement plans. So you add those two things together, you might accidentally reach above $1 million before you even realize it. So what if you need to end the ILIT? Well, it's relatively straightforward. You simply stop paying the premiums. If the premiums aren't paid, the life insurance policy will lapse, and depending upon the terms of the policy, the trust may receive nothing or a reduced payout. But why would you want to end the ILIT? Remember, it's irrevocable, meaning you're locking yourself into keeping the policy funded and the beneficiaries you initially designated. If you ever find yourself unable to maintain the liquidity needed to fund the ILIT, this could effectively invalidate the trust's purpose. Now let's talk about how to fund an ILIT and what to avoid. While cash is the most common way to fund an ILIT, you could theoretically use other assets like income-producing real estate. However, I would strongly advise against that for several reasons. First is liability. If someone sues the owner of the property, they're suing the trust. This subjects everything within the trust, including the life insurance policy, to that lawsuit. Second is tax returns. If the property produces income, the trust will need to file tax returns and pay taxes on the higher income trust tax rates. Third is inflexibility. Once the property is in the trust, it's difficult, if not impossible, to leverage it or sell it without significant complications. Irrevocable trusts are, by design, relatively inflexible. Number 4, a big one, no step-up in basis. When you die, the property in the trust will not get a stepped-up tax basis, meaning your beneficiaries will face hefty capital gains taxes if or when they sell it. And lastly, number 5, a very California problem, property taxes. Transferring real estate into an ILIT will trigger a reassessment of property taxes, locking you into higher tax bills every year from here on out. To put it simply, the ILIT should generate its own wealth, the life insurance payout, without requiring a large amount of wealth to be transferred into it during your lifetime. If you fund it with too much wealth, well, you're tapping into your estate tax exemption level now, which is counterproductive. So what do you think? Is an irrevocable life insurance trust the right tool for you to build generational wealth? Do you have a topic you want me to cover, or did I miss something in today's video? Let me know in the comments below. As always, I'm attorney Andrew Bethel, helping you to build generational wealth for you and your loved ones. Don't forget to like, subscribe, and share this video, and I'll see you at our next meeting.